Federal Reserve System, commonly called the Fed, is the central bank of the United States. It is the institution responsible for guiding the country's monetary system and helping keep the financial system stable. It doesn't function like a regular bank where people deposit money in checking accounts. Instead, its work mainly affects banks, governments, investors, and the broader economy by influencing interest rates, controlling how much money is in the financial system, and supervising financial institutions. One key thing to understand is that the Fed is an instrument of the U.S. government, set up by Congress, but it is designed to be independent. This independence means its core decisions about money and monetary policy are not directly controlled by the president or Congress, even though the people in charge are appointed through the political process. This independence is considered important to prevent short from political pressures from leading to damaging decisions like excessive inflation. When and why the Federal Reserve was created. The Federal Reserve was created on December 23, 1913, when the Federal Reserve Act was signed into law by President Woodrow Wilson. To understand why the Fed was created, you need to know a bit about financial history at the time. In the late 1800s and early 1900s, the U.S. economy suffered from frequent banking panics, situations where people rushed to withdraw their money from banks, causing the banks to fail because they didn't have enough cash on hand. The most severe of these was the Panic of 1907, in which widespread fear caused runs on banks and major financial stress across the country. There was no central authority that could quickly add liquidity into the banking system or coordinate payments. Because of these recurring crises, lawmakers, bankers, and economists pushed for a system that could provide a more elastic supply of money, meaning the ability to expand and contract money in the economy as needed to prevent crises and smooth out financial stress. The Federal Reserve System was Congress's solution to this problem. Original purpose was modern purpose. When it was created, the Fed's main goal was to address banking instability and prevent financial panics. Over time, its role expanded significantly. Today, the Fed has several core missions. It conducts U.S. monetary policy by influencing interest rates and the availability of money and credit in the economy. It supervises and regulates banks to ensure the safety and soundness of financial institutions. It also works to maintain financial stability by monitoring and responding to risks that could disrupt markets. The Fed provides financial services, operating systems that move money and payments between banks, and acting as a fiscal agent for the U.S. government. It also supports economic research and data, analyzing economic activity and publishing data to help markets and policymakers. In fact, Congress has given the Fed 3 statutory goals, which are maximum employment, stable prices, and moderate long-term interest rates. The first 2 goals, maximum employment and stable prices, are often called the dual mandate and guide most of the Fed's monetary policy decisions. How the Federal Reserve System is structured. The Federal Reserve is not a single building or person, but a system composed of several parts. At the top is the Board of Governors, a 7-member body located in Washington, D.C. Each governor is appointed by the President of the United States and confirmed by the Senate, and each serves a 14-year term. One of those governors is designated as the chair and another as vice chair. In 2026, Jerome Powell is serving as the chair of the Federal Reserve with Philip Jefferson as vice chair, and Michelle Bowman as vice chair for supervision after her Senate confirmation in 2025. This long-term length is deliberate because it helps maintain the Fed's independence from short-term political pressure. The system also includes 12 regional Federal Reserves located in major cities across the U.S. The Federal Reserve Bank of New York is especially important because it implements monetary policy decisions in financial markets. Each regional bank has its own president and board of directors, and these banks provide services to commercial banks, perform economic research, and help implement policy at the local level. The Federal Open Market Committee, or FOMC, is the group that actually decides monetary policy, especially interest rate targets and purchases or sales of government securities. The committee includes the 7 governors, the president of the New York Fed, and a rotating group of 4 other regional presidents. How the Federal Reserve works, monetary policy in plain English.
Is Ken Manning, and he's now a professor at MIT, and his family knew our family through the drugstore where they traded. And
the Fed's main job is managing monetary policy, which means influencing how easy or expensive it is for banks and businesses to borrow and spend money. The Fed does this mainly through 3 tools. The first tool is open market operations, which means the Fed buys or sells U.S. government securities, like Treasury bonds, in the open market. When it buys securities, the Fed pays for them by crediting banks' reserve accounts, which increases the amount of money banks have to lend. This typically lowers interest rates and encourages borrowing and investment. When it sells securities, the opposite happens. Banks have less to lend, financing tightens, and interest rates rise. The second tool is the federal funds rate, which is the interest rate that banks charge each other for overnight loans of reserves. This rate is extremely important because it influences nearly every other interest rate in the economy. from mortgages to car loans to business loans. The Fed sets a target range for this rate at FOMC meetings. The third tool is the discount rate and reserve requirements. The discount rate is the rate the Fed charges banks directly for borrowing from the Fed, and reserve requirements are rules about how much money banks must hold back and not lend, though in recent years the Fed has relied more on other tools. By adjusting these tools, the Fed can make borrowing easier or harder. For example, to stimulate a weak economy, the Fed might lower interest rates so businesses and consumers borrow and spend more. To cool down inflation, it might raise rates so borrowing slows and prices stabilize. This system is designed to ensure that the economy grows at a healthy pace and inflation stays under control. Who runs the Fed in 2026? As of 2026, the chair of the Federal Reserve is Jerome Powell, who has been serving in that role and whose term continues until mid-2026 unless extended. The vice chair is Philip Jefferson, and Michelle Bowman serves as the vice chair for supervision, which is a powerful role overseeing how banks are regulated. These leaders influence policy decisions, but monetary policy is ultimately decided collectively by the FOMC. Recent retirements and appointments of regional Fed presidents, such as the announced 2026 retirement of the Atlanta Fed president, can also shift the balance of viewpoints on monetary policy. Do other countries have similar institutions? Yes, most countries in the world have a central bank, institutions similar to the Federal Reserve. For example, the European Central Bank manages monetary policy for the Eurozone. The Bank of England is the central bank of the United Kingdom.
Ken was and is a very brilliant, precocious man, and he had gone several years earlier to some kind of program. It got him eventually into Harvard, and then he went to Harvard Graduate School, and now he's an MIT professor, as I said.
And the Bank of Japan manages monetary policy in Japan. These institutions often work together on global financial issues and share research. The Bank for International Settlements, or BIS, in Switzerland is called the Central Bank for Central Banks, and it brings them together in a way that helps coordinate global financial policy. How money is printed, and how the Fed adds money to the system. People often say the Fed prints money, but that phrase can be misleading. There are really two parts. First, physical currency, which is paper bills and coins, is technically printed by the U.S. Treasury's Bureau of Engraving and Printing and struck by the U.S. Mint, and the Fed distributes this currency to banks as needed. Second, the Fed creates money digitally through its monetary policy tools. When the Fed buys securities in open market operations, it does not literally print dollar bills. Instead, it credits banks' reserve accounts electronically, effectively creating new money in the banking system. This digital creation influences how much banks can lend, which in turn affects the broader money supply. So the Fed doesn't print money in the everyday sense, but it expands the money supply through banking reserves and securities purchases. Why creating money matters and how it affects the economy. Expanding or contracting the money supply is one of the Fed's primary tools for guiding the economy, but it has both benefits and risks. When the economy slows down, the Fed can effectively create money by lowering rates or buying securities. This encourages banks to lend more, which can boost spending and investment. If too much money is introduced relative to actual goods and services, prices can rise, a phenomenon known as inflation. Moderate inflation is normal, but when it accelerates rapidly, it erodes purchasing power, meaning your dollars can buy less. In 2024 and 2025, the Fed lowered interest rates from historically high levels in an effort to stimulate economic activity. Adjusting rates this way impacts borrowing costs, asset prices, and overall economic sentiment. Fed decisions about money, whether tightening or easing, have ripple effects across mortgages, savings rates, business investment, and employment. Too much money creation without real growth can fuel inflation or asset bubbles, while too little can slow growth and increase unemployment. How Fed policies affect everyday life in 2026. Fed policy affects everyday life in ways most people don't realize. For example, when the Fed raises interest rates, mortgage rates usually go up, making home loans more expensive. That means monthly mortgage payments increase, which can slow down home buying and reduce demand in the housing market. Higher interest rates also make it more expensive for businesses to borrow money, which can slow hiring and reduce job growth. When borrowing becomes expensive, businesses are less likely to expand, which can lead to slower employment growth. On the other hand, when the Fed lowers interest rates, mortgage rates typically drop, making it cheaper to buy a home or refinance an existing loan. Lower rates can also encourage businesses to borrow and invest, which can lead to more hiring and economic growth. Inflation is also directly influenced by Fed policy. If the Fed keeps rates low for too long and money supply grows faster than the economy, prices can rise, meaning the cost of everyday goods like groceries and gas increases. In 2026, the Fed has been balancing the need to keep inflation under control while supporting employment growth, which is why their decisions are watched closely by everyone, from homeowners to business owners to investors. Wrap up why the Federal Reserve matters. The Federal Reserve is one of the most important institutions in the U.S. economic system. It was created in response to financial instability, and over the last century its role has grown include guiding monetary policy, regulating and supervising banks, providing financial services and payments infrastructure, maintaining financial stability, and serving as a central coordinator with global counterparts. Understanding the Fed means understanding why interest rates move, how money flows through the economy, and how policymakers try to balance inflation and growth.